Hello, everybody. We're back. It's time for a little truth or skepticism today. I'm Tom Sosnoff. There's Dylan Radigan, all dressed in black. You got the,
It's cold here. I got cashmere turtleneck. It's winter. This is January. This is January in California. This is like a jacket.
You could have just said turtleneck. You didn't have to go cashmere on us.
Well, but it's important, actually. It makes a big, because it allows much more variety of temperature and variety of use.
I am wearing a jacket that was just given to me by somebody, and it's very fashionable for me.
I would say I think the reason that you commented on my turtleneck was in part because you're inspired by how good you seem to feel you look in your new.
No, I'm inspired because in our studios right now.
I agree. Which I agree.
In our studios, Dylan, it's like 55 degrees because.
No, but I think that's a good look because you have the gray shoulder. Remember, I live in Milan. I'm a tastemaker. I have a point of view. I've lived in Milan.
True.
You've got continuity with your beret on the gray of the shoulders.
Yeah. No, it's all there. The hair.
You've got that navy, the sort of the royal sort of.
I agree.
The peaceful king, if you will.
It's like 20 degrees in Chicago, and we have the air conditioning blasting in the studios because everybody gets freaked out. Oh my God, all the lights, and then did you see the pictures we posted yesterday? The new studio, it looks amazing.
I know. Is it on Instagram?
Yeah, I'll send you some. It's cool.
Oh, I'll look right after.
Got to get you out to Chicago. Anyway, again, I'm Tom Sosnoff. He's Dylan Radigan. This is Truth or Skepticism. We are in year like 9 or 10 of doing this show, and
11.
Whatever. I have a topic. I actually have two topics today that I would like to throw at you. There has been a lot of chatter, and one topic actually leads into the other topic. What I want to start with is the discussion around whether or not the retail investor got benefited from or got hurt by the recent launch of all the Bitcoin ETFs because of all the hype. It's classic, buy the rumor, sell the news. Did the retail investor get hurt, or did the retail, which is what is the general consensus on Wall Street, is the retail investor got dumped on at the top by the ETFs coming out at the all-time high, not all-time high, but the most recent high in Bitcoin. And the reality is, I'm going to argue that that is not the case, and the retail investor actually benefited from the rise in Bitcoin, and the institutional investor got picked clean at the top, which is classic to me. That's number one. The second piece, though, to follow that up, is I would like to then transition into the idea that, and to talk about regulations in general, because regulations are so heavy right now, and do they, because everybody complains about, we're too highly regulated, we have too many regulations, there's too many fences, there's too many restrictions, let's let free markets be free markets, let's not hold anything back. And the reality is, does it really matter? Because in the end, in bear markets, regulations help, and in bull markets, regulations don't hurt.
Yeah, those are both worthy discussions. I think there's a lot there. I'm going to retain my.
Okay,
opinion.
so let's start off with the Bitcoin discussion. You're very aware that I think Grayscale and iShares are dominating the current, the space for the new Bitcoin ETFs. I think there was 11 or 12 of them. All of them are similar. All the fee structures are similar. It's very hard to, when you're basically creating an ETF of a physical product. I mean, they're all the same. It's like, how many different ways do you want to do the S&P 500? How many different ways do you want to do Bitcoin? Bitcoin's Bitcoin, blah, blah, blah. The fee structure might be slightly different, but who cares? The reality is, 25 million shares or 22 million shares traded yesterday of Grayscale's, which is GBTC, and then And then the other one is IBIT, which I think traded 13 million shares of stock yesterday. There's no options yet on either one. You can short them now. There's no leverage. So they're fully cash secured, no leverage on the long or short side. But they're trading a lot because they're inexpensive underlyings. One is like, $20 or they're $21 or $29. They're both cheap. They came out about, let's call it 25 to 30% higher when they originally launched the product about whatever it was, a week ago, 10 days ago. So they've lost 25 or 30% in the first week. There's been no price stabilization because they're tied to a digital asset. So on the street, when you read the articles written about this in the Wall Street Journal and other places, other financial magazines, they're basically saying, here's another con job on the retail investor. All of these funds dumped, all of these ETFs on the retail investor because the retail investor had, basically no way to trade this unless you were at Tasty, Robinhood, Interactive Brokers, and maybe one or two other small firms. But the retail investor, unless you open an account at Coinbase or, crypto.com or Binance, no way to really trade this stuff. And so the retail investor wanted to get in, got screwed. And the other side of the argument, which I haven't heard a single person make, but I believe is the actual case, is the retail investor has been sitting long Bitcoin now for years in their wallets, in their brokerage accounts, in pretty much in dead cash, meaning there's nothing you can do with that money except just sit on it, all in passive long digital assets. And this run up from just below 30,000 to just under 50,000 was a huge win for the retail investor. Even now at 40,000, it's a massive win for the retail investor who basically doubled their money by the institutions who were unable to play digital assets because they can't have a hot or cold wallet. They can't use the firms that actually support this stuff because they're not big enough, and they've had no way to trade digital assets. So they were the ones that jumped in. They were the ones that bought these underlying companies. They were the ones that tried to manipulate the stock price and to create a lot of churn in the volume, and they were the ones that got screwed. And so finally, the institutions got it handed to them, and the retail investor benefited from it. And I think that's a feel-good story, but nobody else seems to think that's a story.
So can I comment on that?
It's all yours.
We have a couple of issues with the way you're approaching this.
Okay, I want to hear what they are.
First and foremost, you have to understand who the counterparties are in the story that you're telling. And right now you're conflating two different types of retail investor, one of which is, we'll call a futurist, self-directed investor, wallet holder, tasty trader, Robinhooder, whatever, interactive broker, whatever their action is, but they run their money through some dashboard of self-direction, Schwab, whatever.
Okay.
And then the retail investor, that's your ultimate dead money, which is your RIA managed accounts, and the less active, more conservative, big accounts at the Schwabs and the Tasties, and the bigger accounts at the brokers that are less active, perhaps. And that for sure you're correct. Like everything you say is true, right? The beneficiary obviously was only retail from zero to whatever the price is, and incrementally more over the last decade.
Sure.
It's the biggest coup the retail investors ever. How many $1 trillion? The entire thing we can call retail up till the BTF, basically. What's the enterprise value of Bitcoin on the day of the Grayscale IPO or whatever? Like it's a ton of money. That's the biggest retail victory in history. And I agree with you where get over it because there was a blow off at the top and you didn't keep all the upside. Like welcome to the rodeo. Like get over it, right? Like of course there's going to be a blow off. It doesn't mean somebody picked you off. It just means that's how things price. And I totally agree. And I think anybody logically would just that's self-evidently true. It doesn't require agreement. It's just what happens. But in this case, the community that is that first piece of the retail world that's the self-directed futurist is the beneficiary, but the bag holder is the dead money in the RIAs, I'll call it, which comes through which is a metaphor for the accessibility of the grayscale and whatever the rest of this ETF jazz is, where it goes into allocations, and it's as accessible as Tesla or Apple or whatever. Anybody can show up, right? And I'm just saying that that's a different group of people. And that group of people is the core audience for financial media. And financial media's primary moral mandate, albeit grossly hypocritical and misguided, is born from the journalistic mandate to look out for the little guy, whether it's grandma's electricity in Chicago from Channel 4, you're looking out for the little guy, or the real hard investigative journalism that gets done, at the Boston Globe, or the tobacco stuff and all, like the sort of looking out for the little guy is the ethos of journalism, which then gets pulled over to finance as looking out for the little guy as a proxy for that last man in, that dead RIA money. And you'll of course say incorrectly, well, you shouldn't do that, and that's why we exist, and blah, 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 and welcome to the future. And no one can disagree with you, but it doesn't change what the allocation of money is right now, or what the narrative of like most of the money is not self-directed to this day, right? It's a trust, it's a fund, it's a plan, it's a thing that
sure, whatever, who cares, whatever, right? I agree. Yeah.
And that's the last money that comes to the table, as it were, that's the theoretical identity of the person that financial media imagines themselves as a proxy for, along with the appeal of the Wolf of Wall Street or the Stratton Oakmont pump and dump as a story to get clicks. So if I make the retail investor the rube, and I stand up the Wolf of Wall Street with his razzle dazzle in his limousine in New York, he always gets the money. And
so what you're saying is, I love the trade. What you're saying is that these RIAs, they love it. They love the trade with other people's money.
That's the whole business. The entire industry is based on fee collection for being a proxy for other people's money, as you know.
Of course. Now, does Dylan Radigan have an issue with that? Because it doesn't seem like a lot of people have an issue. I have an issue with that, obviously. Hence the reason why we build all the companies that we build. But I do have an issue with that. I may have different solutions than you have, because I think what is the solution? Like,
I think the solution is mandate. So let's say that there's tall buildings in every city on Earth.
Yeah.
And whether it's a real estate company or an insurance company, like I could go to I don't have to go to Chicago or New York or London. I can go to Birmingham, and there's a tall building, somebody in there who's got a bunch of money.
Okay.
And you could enforce, going to the regulation piece, a mandate for community investment, not through a social network, but through incubators, accelerators, startup partnerships with universities. Most of the money of the world leaves the cities of the world and goes to New York or Chicago or London, because no one who's in charge of money in Birmingham wants responsibility for whatever happens if you invest it in Birmingham.
Well, if you believe that liquidity if you believe in the importance of liquidity like we do, there's a very good reason for not investing in Birmingham or some other place like that, because you basically, there's a couple things. There's no transparency there's no mark to market, so there's no transparency.
No, I know all that. No, yeah. I get all that. But I'm saying that's a world where technology can solve the problem. My point is, the absence of a preferable alternative to the robots, as it were, like other people running robots on other people's money, which is what the industry has come down to, right? One company is just.
I think you're making this into a bigger thing than I want. I think you're making it into a.
Than you intended.
Yeah, my whole point was, level. You have these institutional. Everybody always says that the little guy gets screwed. Okay,
that's a great story, and journalists are hired to do that in their mind.
And because you know what sells? What sells is, hey, little guy, you just got screwed. So now
they love that.
So yeah, of course they love it, because that is the story. We just screwed the little guy, and here's how they screwed you. Okay, they brought
away, clickety click money.
They brought out this. They brought out these products at the absolute high, and And lo and behold, everybody bought them, and now they're 30% lower. So
The Stratton Oakmont pump and dump, I think, is what they call it.
So now you can spend the rest of your life hoping to break even on your ETF buys in digital assets. And my argument is, for one of the first times ever, because that's what happens. So if you buy Uber pre-IPO, or you bought Facebook pre-IPO, or you bought any of these stocks that opened higher and went lower. I'm not talking about what happened 2 years from now, but just stocks that opened up in their IPO and went straight down. You bought GoPro, you bought whatever it was.
We've seen it many times.
You saw it with 1,000 different SPACs. They opened at $10. They're now trading
every
at
one of them.
They opened at $10. They're trading at $1. Okay, across the board, everything. Everybody got effed. Okay, everybody got screwed. So
We saw.
So, and that's always the retail investor. It's always the consumer. Here is a time when the consumer was the only one that was long cash in the digital assets.
In the IPO of the $1 trillion enterprise.
Exactly.
I'm agreeing with you.
This is the one time.
But what I'm saying is both the little guy gets screwed, pump and dump, and the big guy always wins.
No, but there's a message from this.
They both can be true, even if the one group of little guys is the replacement for Sequoia. Instead of Sequoia at Uber, it's a bunch of wallet holders at Bitcoin.
Yeah.
But at the end of the day, when a really hyped IPO goes off, the little guy ends up as a bag holder, typically. If you define the little guy as the IPO stock buyer, that's all.
Grayscale, BlackRock, ARK, iShares. They've been taking care of their institutional friends and screwing the individual investors forever. Here's one time when the institutional investors unintended consequences, they got their underlying doubled. Okay, their Uber that they bought in the pre-IPO is now got doubled. They can sell it anytime they want. They have no restrictions in the cash marketplace.
I'm just saying it's different people that bought it a month ago or 2 months ago or a year ago than bought the ETF.
Whatever. And then the institutions who could not participate, they flipped the cards over. In the private world, it's only the institutions, it's only the accredited investors who could participate. In the public world of digital assets, it was only the opposite way. So the institutions could not participate because they had no access to those marketplaces. They weren't allowed by their funds charters, the objectives, whatever it was. So now they're stuck waiting till this IPO. The IPOs come, they think they're going to stabilize the market. This is going to be something of a hot issue, blah, blah, blah. They bid everything up. It's buy the rumor, sell the news. They all get killed. And the little guy walks away with all the money in his pocket. And nobody writes about it. It's a feel-good story.
Right. But again, you're like an old man complaining that they tell the stories that people want to read, not the ones that are true.
I'm not complaining. I just wanted to throw it out there.
You're just setting the record on this January.
I'm setting the record straight.
So in the future, if someone asks what Tom's position was on the Bitcoin IPO, we can send them this link and be like, you know what? You got it wrong. And here's why.
That's exactly right. That's exactly right. But now, getting back to the reason why this IPO was so screwed up to start with is because because we have either an overzealous SEC or we have crazy regulations on things that people want to control that maybe they shouldn't want to control, or they don't need to control. And I guess, where I'm ultimately going with all this is how important are all these regulations that we have out there? And I mean, we obviously know in 2008, too many markets were not, there was no risk controls, there was no regulation in certain markets, and lo and behold, we blew up. And sometimes because of greed, because of lots of other things,
Fraud.
Yeah, fraud, greed, criminality, whatever it is, things blow up.
Leverage, but the final word at the end of the day is called leverage, I believe.
Size kills. Yeah, leverage, size, whatever you want to talk about.
100 to 1 going the wrong way.
Yeah, Exactly. But
With a lot of zeros.
who got greedy in the banking crisis from, a year ago? Who got greedy? All these firms that were trying to ladder out because they weren't making any money on their assets, on their cash balances. So they laddered out their money.
Time.
They got inverted on the yield curve and they got screwed.
Mm-hmm.
So,
pounded.
so the thing is, I guess the couple points I want to make is, first of all,
You're saying the people are winning, sir.
yes, it's okay.
You're saying this is not a time to cry in your milk. They got one over once again. This is a historic victory for Rome. To establish the fact that outside of the institutional world, whatever the enterprise value of Bitcoin is, many hundreds of billions, I guess, trillion, 500 billion, a billion, 500 billion, was created outside of the traditional finance world and had an IPO.
Yeah. Yeah. Yeah.
And you're saying that should be celebrated instead of being looked at as an additional evidence of exploitation.
I am saying that.
Uh-huh.
And I feel strongly about that.
That you made clear. And then you're saying, additionally, that the regulatory environment, which gets a lot of complaint, in the same vein that the little guy getting screwed gets complaint, that's also an appealing complaint, right? To complain about the same way you want to complain about Grayscale or ARC or whatever, the anonymous superpower, no person, just a devil. The regulators occupy the same identity, right? Where you're like, these guys, whoever it is, whatever the thing is, the portal, the paperwork, the inspection, the audit, the filing, every industry. And you're asserting that it's actually a good defense, at least when it comes to managing leverage. You're saying you're not getting into the weeds of, obviously, I'm sure, the regulatory environment, which I think is driven by I think the regulatory environment is only as good as the North Star or the first principles of that regulation. Like if the regulation is to be transparent and to have everything listed and have everything and focus on liquidity, and then regulations can fall from those three ideas infinitely. And the issue, I think, is that the presumption from regulatory is that people are unable to make decisions and need to be told what to do, which is, I think, the primary complaint of private enterprise when it comes to regulation. And so I think the controversy in what you're saying is you're suggesting that regulation isn't as bad as everybody thinks it is, if I understand you correctly.
I am saying that. I'm also saying is regulation nothing more than a bull or bear market phenomenon? Like
meaning what?
Meaning that is regulation just something that is the cries for regulation something that happens in a bear market, and is the cries for no regulation something that happens in a bull market, and does it so in other words, is this like everything else where we think we try to create a narrative around we try to the financial markets are very strange because they allow you to create these kind of third-party subjective narratives that nobody can actually prove. And my argument about regulations now is that I think they kind of feel like they're just, a derivative of bull and bear markets.
What do regulations do in a bull market? Become looser?
They don't hold back bull markets. They don't really play a role. Let's put it that way. And so they essentially get dropped, or they get people. They're
not an impediment to growth or enterprise.
They're not a hurdle. Yes.
So they're not regulations. The number one thing, regulations, the much like the little guy, always complain it's a hurdle, an impediment. In the bull market, you're saying, no, actually, it's fine. Relax, deal with it.
I'm saying this is another example of something where we create a story, and it's really just about the marketplace itself. Like, I think that people get very confused about like everything from valuations to probabilities to other things when essentially an efficient marketplace tells a much more important story. And I don't know if there's, if we kind of just try to create a narrative to justify the regulations, or I don't think it's the other way around. I guess that's how I'm thinking about it. So, for example, with Bitcoin, let's just use that as an example.
Right.
So when Bitcoin is kind of just lagging behind, it's just sitting around, and it's like, and people that, and remember, everybody's passive long and everybody's nervous. And then you find a situation like, an FTX pops its head up, or a Binance pops its head up, or some other firm with some level of fraud or questionable ethics or whatever else it is. Everybody's head pops up out of the sand, and all of a sudden our focus is solely on regulation to solve that. All of a sudden price goes up, everybody's happy, nobody cares about regulation anymore, roll out your Bitcoin products.
Okay, I dig it, I got it. So let me extend it, I dig it. And okay. I'll tie this back to your Elon Musk position the other week or day or whenever it was, which is because for you, the church of capitalism, or the church of prosperity, or the church of opportunity, or the church of education, the church of the future lives on the integrity of contract law, the integrity of markets, and the efficiency and depth of liquidity and accessibility. And you're saying anything that leads to belief in the integrity is more valuable than whatever the cost may be.
Yeah.
That you're saying that basically, if regulation, if you win on the integrity, the delta on integrity, because it's a bigger, it basically has more leverage. If you move integrity up 1% across the entire system, everything goes up 10%, kind of a thing.
I'm actually just trying to prove the effectiveness and the importance of efficient markets on a stable, growing economy. So like what people don't realize is, I shouldn't say what people don't realize, but what I don't think is given enough credit for the reason why everything in this country works a little bit better than it does in other places with respect to the way our economy works.
Italy, Germany, I mean,
with respect to how it works and how it grows, is that we have an underlying marketplace with massive amounts of liquidity that support a free market, and which allow us to get through situations that other places without that, so they have to create a narrative and a story to adjust because they don't have the underlying foundation. The one thing that we don't have that is protected by, quote, a really free market in this country is our political system, because that's broken, because that doesn't have a way for it to self-police itself and to make everything kind of right, because it's broken, and there's no free market that exists around politics. But everything else, as long as there's an economic outcome rather than like an opinion outcome, then it works.
It works better than most because it's more transparent.
It's deeper. It's got more liquidity. Yes.
And also, but it's also more transparent and more fair.
Yes. It's very fair.
More fair than other countries, where it's not
that's
just,
right, and that's why that's the whole American dream thing.
Right.
That's why everybody wants to come here.
That's only as good as people believing that if they buy the Bitcoin ETF, that they have a chance too, but also understanding the difference between being late to the party for any IPO. You shouldn't buy any IPO on the first week of trading. It's nuts. Like it's the wrong time to buy that company. You don't know. I mean that's like a Wall Street lesson. That your point is a broken IPO happens all the time.
The only reason people ever bought IPOs on the opening is not because they thought, oh my God, this is the greatest trade in the world, I'm buying this IPO. The reason people bought IPOs and is only because they believed that somebody else out there was willing to pay more.
It was the original crypto. It was a pure speculation.
Nobody buys an IPO because, oh my God, I love this company, or I don't think I'm going to get it cheaper.
I'm getting Uber stock cheap today.
Nobody thinks that. They know I mean, I hope they know. They know that somebody is unloading this. That the people that built this company
It's a frenzy. This is a frenzy.
This is an exit. This is an absolute exit for people. So, and everybody knows that. But the only reason you would buy it is because you believe that if you buy it at X dollars, it's going to open for trading because somebody else is going to pay higher for it. That's it. And you don't know why, and you don't care why. You just care that you have a chance to make money. It's just an opportunity. That's why I had this discussion today with all this fundamental stuff versus just kind of efficient markets. Everything is based around efficient markets. Nothing else matters,
including regulation. This is your revelation.
Including regulations, exactly.
This is the revelation of 2024. This is an expansion of the efficient market thesis to include the entire regulatory apparatus, and with a nod towards the power of narrative and the human psychological condition, which clings to pre-existing prejudices about regulation or little guys, which distract us from reality.
I like that.
Okay, so let's talk about that. I accept that. So we have to, but we can't throw it out. So we have a psychological problem with all humans because we love stories and we love villains and little guys, heroes and villains. We want anonymous villains and we want soothsayers, futurists. We want heroes and villains.
Okay.
And you're going to have that. Regulators going to be a villain. Little guy's going to get screwed. Even when the little guy didn't get screwed, the story's going to get told. Even when the regulator didn't screw it up, the story's going to get told. Does the story matter? In other words, is the only thing that matters is the self-awareness to know that you don't have to worry about that story? Is that the revelation?
I think so. I think so.
It's not that there's some action or that there's some...
I think so.
But if your mindset, if you're aware of the story's place in the reality, which is actually subordinate to the market, not superior to the market, you're saying the story is perceived as superior to the world, right? Whatever the story is. The little guy.
Yeah,
the dynamic.
I am saying that.
And now you're saying, no, the story is subordinate to the market because the story is regulation goes this way in bull markets and that way in bear markets. And the story will always be the little guy and the regulator because we'll always have heroes and villains. And so you just have to not take that too seriously.
Yeah, that's a nice way of saying it. That's a very kind and beautiful, well articulated.
My Italian lifestyle in my early 50s.
It's very Italian, very Tuscan.
It's cashmere. That's cashmere talking. But I think that's an interesting, but basically at the end of the day, self-directed trading of being a futurist trader, a tasty trader, or any self-directed trader is also a different mindset, right? Like you're in the mindset business. You have content, you have a technology platform, and you're saying your mindset should be no one knows more than you do, and no one cares more than you do.
Which has always been what we've said, but
right.
But our mindset that's different. So that's the underlying theme to what we always believe. But our mindset is that we're opportunists, and
fair enough, yeah.
And we're always the opportunist. And
our vulnerability as an opportunist is to be seduced by story, which has primacy in our culture.
Our vulnerability as an opportunist is that people can get swept up in the emotion. Like right now, there's an incredible emotion in the markets around, let's call it AI and AI-based stocks.
Story has power. Story is the most powerful. It's a very
powerful story. There's way too much emotion. So blindly, people will buy anything that says AI in it, just like they bought anything that said .com in it, however many years ago. It's a death trade waiting to happen.
No, but we're talking about the opportunist.
No, I understand. So the opportunist. What's the
vulnerability of story?
So the opportunist steps in front of that train at some point, because at some point you have to get in front of a train. You don't know where you are when the train's going to stop, but at some point you have to get in front of the train. So at some point you get in front of the train, and many times you get run over, and that's the thing that sucks.
70 or 80% of the time you get run over.
That's the thing that sucks about being an opportunist.
70 or I'm going to tell you, I'm going to be conservative and brutal and say 4 out of 5 times everything is right. You're right about the direction. You're right about this or that. But there's some piece of that that's not right that at least ends up lower. I won't say a wipeout, but down from 1 to 95 cents to 1 to 50 cents to 1 to whatever it is. And that the mindset requires sizing. It's a whole strategy, right? That you can endure those losses, but because of size and distribution, 60%, so you get 45%, even it's plus 20% on the whole portfolio, or 10 or 50 or whatever, because of whatever happened with the winners, and because the losers are small enough. But the vulnerability is still the story overtakes, because you step in front of the train and the number of losers go up because stories run wild and you're in front of the train at the wrong time.
But you do understand that that number should be 50-50. It should be.
Well, even if it is 50-50, you're still the story's power.
Yeah. So that's
Story's
why.
Power.
That's
I mean,
why.
maybe it should be 50-50, but that's not what the market shows. That's not what's in the IG disclosure for their binaries, right?
No, but the marketplace, so what separates, so wealth creation.
And I'm not even saying this is the same as that, but I'm just saying the worst interpretation of independent speculation is.
No, I understand that. But what I'm saying is that wealth creation actually comes down to your ability to either time or time, or your ability
know something to get in front of the story at the right time.
Yeah, maybe it's a guess. Maybe you waited long enough. Maybe
technical,
whatever.
Astrology, strategist. Tom said it. Moon is full. Whatever, man.
Exactly. So don't discount the full moon tonight.
But what I'm saying, you're saying the story can run you over. Yeah. Because you don't know when you get in front of the train.
That's what normalizes the marketplace. I'm just explaining markets. I'm not suggesting how to, nobody's ever.
Be aware of the story and use it. Don't forget to consider the story when you choose your trains to step.
Because if you're aware of it and you understand it, then the only person responsible for your success is you, and the only person responsible for your failures is you, and that way you don't have to blame it on somebody else that basically lost, that didn't perform under what we consider to be obvious situations, like the Bitcoin ETF. That's where the consensus of buy the rumor, sell the news comes from. I mean, that is the core of that. Is that most people.
So that's why they made Martin Scorsese made Wolf of Wall Street about this. I mean, this is one of the most seductive ideas. This is second only to mafia movies. I mean, the little guy getting screwed is a part of the basis.
Yeah, but also, the amount of margin that's borrowed from, that our customers borrow from us at market highs is almost 5 times what it is at market lows. So if somebody borrows, if we're loaning out $1, we're probably near a market high. If we're loaning out 20 cents, we're probably near a market low, and that's kind of the ratio. And that is so classic, which just shows how everybody's always wrong.
Which points to the vulnerability to story as the menace and force that is at war, or in relationship, and not necessarily at war, but in influence with the market. And you're saying the market creates a story, and other people say, no, the story creates the market. Yeah. That's the debate on the mountain. So now let's use your superpowers in fantasy land. Let's say that there's $10 that's all the global assets in the world under management for so-called retail custody, RIA, Morgan Stanley, Tasty Trade, and everything, wallets, everything in between. And let's say $1 is self-directed between the domain of self-direction, however you want to call it, and $9 is managed and super passive in some way. And the people with the $9 would be happy to do something that's not that. Where would you put that money? Would you return it to the owners and tell them to log on? If you're Moses, and you can move money, what happens to it? Anything you want.
It's a really interesting question, because I've never been faced with that, because I don't manage other people's money, but I've been around people that do. And a buddy of mine managed a hedge fund, and at one point he said, you know what? I'm returning all the money, because I don't. He goes, I thought about this, and he goes, I just don't. He goes, I couldn't answer that. He couldn't answer that question that you just asked.
So now you're like a kid in class complaining, regulation, self-direction, all the things. You make it up to
I can answer that question myself.
Chairman
because
General is like, okay, anything you want. Well, I got $9 over here, $1 over here.
Right, but I can answer that question myself because I'm always finding places to put my money and things to do with my money. I mean, I've been doing that for my whole life. I'm pretty good at it, just finding things to do with my money. I'm cool with that, but I don't know if everybody is. But it's a skill.
I understand that. And so let's say there's some ceiling on the number of people that are you or a derivative of you, half a Tom, quarter Tom, double Tom.
Yeah,
but
whatever.
like the domain of your sort of aptitudes and interests and skills, one way, some derivative of that. And then you have another person who is fully passive, as a retired in Santa Barbara or Oklahoma, and they just, come on, pay the rent. And that's the most extreme. You're opposite, right? And then everybody's in between those two people, right? Obviously, the person in Oklahoma, no. You, obviously, yes. And everybody's in between.
Well, the irony of that is the person that's retired in Santa Barbara or Oklahoma, wherever you mentioned, probably didn't get there that way, but now they've settled for that.
For sure. Or of course, that's true, right? They had a bid, they had a thing.
Yeah, whatever.
Yeah. But now and so what do you do with that money? And they just want to have somebody younger than them who's smart and who has packages and decks and certifications and regulations. And
do you know that? Do you know who that person? Do you know that person?
Everybody knows somebody like that.
I don't know anybody. I don't know anybody like that.
You don't know anybody who works for Morgan Stanley or Fidelity.
Oh, I know people that work for them. I don't know anybody that I would say, okay, here's my money.
Oh, no, I understand. It's a different question, but I'm saying it's a genre of people. Those are the people that they want to call from Oklahoma or Santa Barbara and say, how's it going?
I get it. I get that.
So you're not going to mess with that dollar. Let's make that $1. Now I got $8. Anyway, think about it. There's some number of dollars you're going to leave in Oklahoma or Santa Barbara, maybe half, $5. They're old.
I like this discussion today. I'm Tom Sosnoff. He's Dylan Radigan.
Bring a couple, $2-3 out, though. We could bring a couple, but $1 doubles the industry. You could do it.
That's right.
$1.
We talked about Bitcoin ETFs, digital assets. We talked about regulation, and is there the leverage of integrity for buoyancy in the markets, perceived integrity, huge leverage. Very interesting. Dylan, thanks so much. We'll see you next week.
And you got your political comment, and I heard what you said.
What political comment?
You said it as if it was a self-evident truth. The American political system is broken and non-functional.
Well, it's broken because we don't have an efficient market to keep it in line. So the only marketplace we have that the market's been abandoned. I mean, the issue is you want to talk about forget the candidates and okay. It's a busted system. The whole apparatus. It is a busted system.
Governance is busted.
Yeah, it's busted.
Transparency is non-existent. It's busted, right?
Yeah.
So let's so then again, and the consequence of a busted market is what? People abandon the market, right? They just don't go to this, and so people don't vote. It's a different meeting on a different podcast. We've run the clock.
Yeah.
But it's more about how you get a market that's been abandoned for lack of
it wouldn't surprise me, because you mentioned this. It would not surprise me that in the upcoming presidential election, you see the lowest voter turnout we've seen.
Total abandonment of the market.
That's right. That's exactly right.
It's the only available response to participants. Because you don't have governance.
Yeah.
There's no regulatory intervention, no legal intervention.
Yep, that's it.
Abandonment is the only option. Anyway, our homework, both of us, for this week is to repair an abandoned market. Or back next week.
I'm Tom Sosnoff. He's Dylan Radigan. We'll see you next Wednesday, 1 p.m. Truth or Skepticism. Thanks so much.
See you later.